The Fed just spoke, and it spoke firmly. It held its ground. It sounded about as resolute on inflation as it has sounded in a long time, the kind of tone that is supposed to make gold sit down and behave. And gold did the opposite. It didn't flinch, it didn't apologize, it turned and went the other way. That is not supposed to happen. When a central bank sounds tough, the old rulebook says the metal that pays you nothing is supposed to sag. Instead, gold answered back in one move, and the answer was not aimed at the words the Fed said out loud. If you are holding gold in your retirement account right now, or you have been sitting on the sidelines wondering whether you already missed it, I need you to understand what just happened, because it was not a reaction to a headline. It was a reaction to something underneath the headline, something the big banks and the financial channels are very careful not to explain to you in plain English. By the time we are done, you are going to understand exactly what gold was answering, why it looked past the tough talk entirely, and what that tells you about the years your savings have to survive. So let me give you the first real piece right now, because I do not believe in making you wait 20 minutes for something to chew on. There was a stretch in this country, lasting roughly a decade, when the Federal Reserve was not actually allowed to fight inflation. Not because it was foolish, not because it was asleep, but because it had a more important job. Its job was to keep the government's borrowing costs pinned down, to hold the interest rate on Treasury debt at a low level no matter what prices were doing to ordinary families. The central bank was, in plain terms, the funding arm of the Treasury. And gold, if you understand that era, is starting to smell it coming back. That era has a name and a turning point, and I want you to hold on to it, because it is the spine of everything I am going to show you. The turning point was an agreement reached in the early 1950s, an accord between the Treasury and the Federal Reserve. Before that accord, going back through the war years, the Fed had been holding the yield on government bonds down by force, buying whatever it had to buy to keep those rates from rising. Washington had a mountain of war debt, and a central bank that lets interest rates climb on a mountain of debt is a central bank that bankrupts its own government. So the Fed was told, quietly and firmly, to keep the lid on. Economists have a cold, clinical name for that arrangement. They call it fiscal dominance. Fiscal dominance means the central bank no longer sets policy for the health of the currency. It sets policy for the solvency of the government. When the debt gets big enough, the Fed loses its independence in practice even while it keeps it on paper. It cannot raise rates as high as inflation would demand, because doing so would blow a hole in the government's budget it could never fill. So it holds. It lets inflation run a little hotter, or a lot hotter, and it calls that patience. The saver, the retiree, the person who did everything right and put money into safe government bonds, that person eats the loss. Quietly, year after year. I want you to picture one of those savers, because this is not an abstraction. Picture a man in that era who bought government bonds because his country asked him to, because it was the safe, patriotic, responsible thing to do. He held them. He trusted them. And across that pinned decade, while the Fed kept the interest rate artificially low, inflation ate into what those bonds could actually buy. He got his dollars back, every one of them. They just did not buy what they used to. Nobody robbed him at gunpoint. He was quietly clipped, a little each year, by a policy that was never designed to protect him. It was designed to fund the government. And he never got a letter warning him it was happening. Now look at where we sit today, and you will understand why gold looked straight through the tough talk. The debt of this country is not a war-sized debt anymore. It is far larger relative to the whole economy than almost anything in our peacetime history, and it is growing faster than the economy that has to carry it. Every year, the interest bill on that debt climbs. And here is the trap that gold has already sniffed out. If inflation flares up again, the honest response is to raise interest rates and hold them high. But high rates on a debt this size mean an interest bill that starts to crowd out everything else the government wants to do. At some point, the math forces a choice. Protect the currency or protect the government's ability to keep borrowing. History tells you which one wins. That is what gold was answering. Not the current stance, not the firm words, not whether rates went one notch this way or that. Gold is not trading on the meeting that just happened. Gold is trading on the end game, on the growing suspicion that no matter how tough the central bank talks today, the sheer size of the debt will eventually force it back into the role it played before that 1950s accord, back into fiscal dominance. A Fed that must fund the debt, whatever that does to the dollar in your pocket. When the market starts to believe that, it does not wait for permission. It front-runs it. And the thing it buys to front-run it is the one asset that has no debt attached to it, no promise from any government, no counterparty who can quietly clip you. It buys gold. Let me pause here, because this is exactly the point where you should be thinking about your own money, not just the theory. If the lesson of that pinned decade is that safe government paper can quietly lose its purchasing power while the central bank looks the other way, then the question for you is simple. What in your retirement account is genuinely outside that trap? And this is where I want to tell you something that most people your age have never had explained to them clearly. The largest, most sophisticated buyers on the planet, the central banks themselves, have been accumulating gold at a record pace, well above anything they did in the decade before, and they are doing it precisely because gold sitting in their own vault cannot be inflated away or frozen by anyone else. Now here is the part almost nobody tells the ordinary saver. There is a completely legal way for you to do the very same thing inside the retirement account you already have. You can move a portion of an existing 401k or IRA into physical gold and silver, held for you in an approved depository, through what is called a self-directed precious metals IRA, without triggering taxes and without triggering penalties, because it is a transfer, not a withdrawal. This is not some exotic club for insiders. If you have $100,000 or more in any retirement account, this is squarely for you. We put together a free guide that walks through exactly how it works, step by step. If you are watching this on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. It costs you nothing. And for accounts over that size, there is a free, no obligation one-on-one to answer your specific questions. Now let me take you back to the mechanism, because I want you to see how deep this goes. The reason gold broke its old habits is that the old relationship, the one every trading desk on Wall Street was built to exploit, has quietly stopped working. For decades, the rule was simple. When interest rates that beat inflation went up, gold went down. Why hold a metal that pays nothing when a bond pays you a real return? That was the one true enemy of gold, an honest interest rate that actually rewarded you. And there was an era, not so long ago, when a Fed chair took interest rates up into the high teens and did exactly that. Broke the back of inflation and broke the back of gold for the better part of 2 decades. So the desks learned the rule. Rates up, gold down. They still trade it that way. They still talk about it that way on the financial channels. But recently, gold climbed even while those real rates stayed high. The inverse relationship broke. And the reason it broke is the reason this whole video matters. The market has stopped believing that today's tough stance can last, because it can see the same debt math you can now see. It has started to price a future where the Fed cannot keep rates high enough for long enough, because the government cannot afford it. When the market believes a bond's real return will eventually be sacrificed to fund the government, that bond's return stops being gold's enemy. And gold is free to rise even when the old rulebook says it should fall. That break, that decoupling, is the single clearest fingerprint of fiscal dominance being priced in before it arrives. And the desks that built their careers on the old rule are the last people who will explain that to you, because it means the machine they run is pointed the wrong way. And do not let anyone tell you this is only about some far-off worry. Think about what the current chair, Kevin Warsh, is actually navigating. He can talk as tough as he likes about prices, and by all accounts he has, holding the line and letting the market feel his resolve. But resolve is cheap when the debt is small, and ruinous when the debt is enormous. The words a central bank uses and the position it is trapped in are 2 different things, and gold has always been better than any of us at telling them apart. A central bank can sound like it is in charge right up until the moment the arithmetic of the debt takes the wheel. That is the lesson buried in that 1950s accord. For years, the Fed sounded like a central bank, but it was operating like the Treasury's checkbook, because the debt from the war left it no other choice. The word said independence. The reality was fiscal dominance. And gold has started to wager that the same gap is opening again, that the tough talk is real today and expendable tomorrow. Here is the part that actually changes things, and almost nobody walks you all the way to it. We have watched central banks respond to a hard lesson. When the reserves of a major country were frozen a few years ago, every other central bank on earth took a note. Reserves you hold as another country's currency or another country's bonds can be switched off by that country. Gold sitting in your own vault cannot. So the buying accelerated. Gold overtook another major currency to become the second largest reserve asset held by central banks in the world, behind only the dollar. Think about what that means. The institutions that manage the savings of entire nations have been quietly repositioning year after year toward the one asset that answers to no government. They are not doing that because they expect calm. They are doing it because they have run the same debt math, and they have decided they would rather hold the thing that cannot be clipped. And this is where the enemy comes back into focus, because you have to ask why you were never told any of this in plain language. The trading desks make their money on your movement, on your fear, on your churn. The financial media needs you tuned to the meeting, to the tough talk, to the drama of a single decision, because that drama sells. What none of them profit from is you understanding the slow structural story underneath. The story of a debt so large it eventually captures the central bank that is supposed to police it. That story does not fit in a headline. It does not make you trade this week. It just makes you quietly protect yourself once and stop being their customer. That is precisely why it stays buried. Now, let me be honest with you. The way I would want someone to be honest with my own parents, because you have earned that, and because the financial channels will never give it to you. Gold is not a straight line up. It has had brutal years inside its greatest bull markets. There was a stretch mid-run in the 1970s where gold nearly cut in half, and plenty of people gave up right there, convinced the whole thing was over, only to watch it multiply many times over in the years that followed. There was a year more recently when a mere hint that the Fed might slow down its support sent gold down by roughly a quarter in a matter of months. Understand that the people who move the cost of holding these positions, the exchanges and the desks, can shake the metal hard in the short term without a single thing changing in the underlying story. They move the cost of holding. They do not move the debt. They do not move the math. So, what does that mean for what you actually do? A few plain principles, and then I will get out of your way. First, own the metal, not a paper promise about the metal. The whole lesson of fiscal dominance is that promises get quietly clipped when the pressure comes, and a paper claim on gold is still just a promise from someone who can fail you. Second, size your position so that a shakeout, and there will be shakeouts, can never force your hand. If a 30% scare would make you sell at the bottom, you own too much. If you own an amount you can hold through the noise cannot hurt you. Third, and this is the one that separates the people who win from the people who capitulate, do not sell into the shakeout. The shakeout is designed, whether by intention or just by the mechanics of leverage, to separate patient owners from their metal at the worst possible moment. This is a case, a strong one, but it is a case and not a guarantee, and it is not personal financial advice. Weigh it for your own situation. Because here is the truth about where we are in this story, and I want you to really sit with it. You are early, not late, early. The smart money, the central banks, the institutions that manage the wealth of nations, they already see it. They are already positioned. They have been buying for years while the crowd argued about a single meeting. But the mainstream has not caught on. The pension funds are still overwhelmingly in paper. The financial media is still narrating the tough talk as if the tough talk were the whole story. Your neighbor is not talking about fiscal dominance at the dinner table. And that gap between what the smart money already knows and what the crowd has not yet realized, that gap is the entire opportunity. Because by the time it is obvious, by the time it leads every news segment and every advisor at every bank is finally recommending it, the easy part will already be behind us. The price will already reflect it. Nobody is going to send you an invitation to this. Nobody is going to call you the day before the crowd arrives and tell you it is time. That is not how any of this works. The invitation is the understanding itself. It is seeing the pattern early enough to act while acting is still calm, still cheap, still fully your choice. The window where a decision like this is easy and reversible is exactly the window where nothing feels urgent. And that window is open right now, precisely because the crowd is still looking the other way. So if you have watched this far, you understand something now that most people your age will not understand until it is too late to matter. Let me give you the way to act on it, calmly, with real information and no pressure. For those of you with a $100,000 or more in a 401k or an IRA, we hold a free one-on-one educational web conference. And if you mention that you watched this all the way to the end, you get a spot. It is not a sales call. It is a working session to understand whether moving a portion of your retirement into physical gold and silver actually fits your situation, how the tax-free transfer works, and what the honest risks are. The reason to do it now is not fake urgency. It is the opposite. It is that the best time to make a decision like this is while it still feels like there is no rush, because that calm is exactly what disappears once everyone else finally sees it. If you are watching on your television, scan the QR code on your screen. If you are on your phone or your computer, go to jeffreeguide.com. So let me bring it all the way back to where we started. The Fed spoke firmly, and gold answered by turning the other way. And now you know why. It was not answering the words. It was answering the debt. It looked past the tough talk and priced the thing the tough talk cannot change. The slow gravitational pull of a debt so large it will one day force the central bank back into the role it played before that 1950s accord, funding the government first and defending your dollar second. Gold answered the Fed in one move because it was answering a question the Fed will not admit is being asked. And the man who bought those safe government bonds all those years ago, the one who got every dollar back and watched every dollar buy less, he is not a history lesson. He is a warning. You do not have to be him. But you do have to decide, while the deciding is still quiet, whose side of that trade you want to be on.